Hello, my name is Eddie Hood. I am one of the founding partners here at Ignite Spot Outsourced Accounting. In this video, I'm going to show you a piece of our Ignite Spot coaching tool. Ignite is actually an acronym if you didn't know. Each letter stands for a different area of coaching focus that we try to help our clients out with. We believe that there are 7 financial traps that most businesses fall plague to. And the first one that we're talking about today, the letter I, is about your income maximization. A lot of businesses simply don't have a budget. If they do, it's not being put into practice, and so that's one of our key focuses here. You have to have a plan, and so once the plan's built, you need to get it into your software and track your actuals against it and all of those things. But this is where it all starts. So this is the Ignite Spot budgeting tool that we set up with each of our clients, and all you do is down the left-hand side, you'll see a listing of all of the main accounts that we have, and they're in a collapsed view. So for example, revenue, it just says revenue. We don't have all of the budgeted line items for each of your revenue departments. You can get more detailed if you want, but here we're just trying to look at total revenue for the business. And what you'll do is you'll go in and you'll push that number out all the way through the end of the year, and your job is just to fill in the blue cells. I failed to mention in row 9, you actually have a drop down here. If you highlight that cell and click it, you can change this from an actual month to a budgeted month, and it'll highlight the cell differently depending on what you pick. But that just gives you a view of whether these are actual numbers or whether they're budgeted numbers. Once you get your revenue put into the system, go ahead and put your cost of goods sold into the system. And we tend to think of cost of goods sold a little differently than most accountants, mainly for planning purposes. Cost of goods sold here for us are the cost of all of your supplies and all of your materials that go into creating the sale of your product or service. And that's it. We don't have labor built into that number just yet. We pull labor out so that you can see it as its own line item, and that allows you as the business owner to make better decisions about the amount of money you're putting into your staff. The reason we do that is because labor is usually one of the largest, if not the largest, expenses that a business has to incur, so we want to make sure that you can manage around that figure. If the cell is not colored blue, don't worry about touching it. Those are just formulas. What this one's telling us here is our gross profit figure, and it's just subtracting from the revenue figure the cost of your supplies and materials. So in this case, the company has $61,000 left after they've bought their supplies and materials. And then the percentage figure down here just says that for every dollar you're generating in sales, you get to keep 94.92 cents of that after you buy your supplies and materials. So obviously you want this figure to be as high as possible. That means that you're controlling your costs. If this were to be very low, you're giving a lot of your margin away up front before you can pay for your business. Okay, the next line down, which is a blue row, is a row that you would fill out. This is the amount of money you're planning to spend on your laborers in the field, the people that are actually providing the service or making the product directly. So this does not include your management team. It doesn't include the secretary or the bookkeeper. It's just the people touching the product or the service or relating directly with the customer. Okay. Now the next formula down is your contribution margin. What this does is it takes your gross profit and it subtracts how much you're spending on your direct labor, and it says this is what you have left. In this case, $30,182. All that means, and the reason why we call it a contribution margin is because that's the amount of money you get to contribute to the business to pay for running all of the other expenses, rent, utility, insurance, all of that stuff. It contributes to your overhead cost. All right. Below that is a ratio that I really, really like. This is your direct LER. And what that means, you'll notice that it's in a dollar format, $1.96 here, and I love this format. The reason why is because what this tells you, if you double click on this, it's taking your gross profit and your direct labor, and it's dividing them. And all that means is that for every dollar you spend on direct labor, in this case $31,000, you're generating $61,000 in revenue. In other words, for every dollar you spend on labor, you get $1.96 in revenue. So you want this number to be high as well, and if it's increasing, that means you're getting more and more out of your labor force than, well, if it was decreasing, they would be becoming less and less productive. So obviously you don't want this number to be getting lower and lower and lower all the way down, or else you could have a problem on your hands. You're essentially setting your staff up to take on less and less capacity and make less money for you. So that's a valuable ratio. The next are all of your overhead expenses, and these are just set up in major categories. Now I know you've probably got a million operating expense accounts. We don't want to see that in the main budget here, just because it gets too complicated and it creates a gigantic forecast and a gigantic budget that nobody's going to use. You need to keep this simple so that it actually gets used. And so to do that, excuse me, we've got the facilities expenses, your marketing expenses, the salaries you're going to spend for your management team and your administration team. So again, this is where you could put the bookkeepers and their secretaries and all the people running the office. I like to break training expenses out as its own separate line item, just because training your staff is so vital. It's so important. Make sure that you have money set aside for that. Your payroll and your benefits, or your payroll taxes, excuse me, and your benefits to your employees. And any other operating expenses. So we lump all those together here. This would be meals and entertainment. This could be insurance, office supplies, all that other stuff. Okay, it just gets lumped in there, and you set a budget for that. The next formula down is going to be your total operating expenses. That's just a sum of all of these guys here. And then your management LER, which is a dollar figure that shows how effective your management team is being in terms of how much contribution margin is left. So what happens here is it takes your contribution margin and it divides it by the amount of money you're spending for your administrative staff. And we want this figure to be as high as possible too, because that means that the management team is really being effective. If it gets lower and lower and lower, that means they're carrying less and less weight, and you're just getting top heavy as a business, which is no good. Your net operating income just looks at your contribution margin, which again, if you remember, this is the amount of money you have left after you pay for your material and supplies and your direct labor. And it takes all of the expenses out and it says, here's what you have left. And that's all it is. From there, we're going to take out your depreciation and your interest, and everything works out so that you can see a figure down here called pre-tax net income. And our goal at Ignite Spot, one of our 3 mission statements is to make sure that every business is profitable by at least 10%. So if this tool is set up so that the percentage down here is greater than 10%, it's going to turn big and bright and green, and that's a good thing. But if it gets to less than 10%, it turns red as a warning. So let's say I put this to, I don't know, 50,000 as a revenue point. If we were planning that, this tells me, hey, this isn't going to work out. All right. First of all, you're losing money, but second of all, as a red warning, I need to do something with this month and plan better so that I can be at least 10% profitable. Being 1%, 3%, 5%, that's not good enough. We want to figure out a way to get your business to 10% or greater, and that's where you want to be. So that's the Ignite Spot income maximization part of our tool, and I hope that helps as you plan out your budget for the year. Thanks.